Welcome to This Explainer. Today, we're doing something a little bit different. We are peeling back that polished exterior of friendly local branches and shiny mobile apps to expose the hidden economics and, frankly, the massive systemic risks of the banking industry. We're opening the vault.
So picture this. You wake up tomorrow morning, stretch, and realize, bam, you are the proud owner of a massive financial institution. You'd probably wonder if you've instantly become a billionaire, right? With passive income just effortlessly flowing in. It sounds like the absolute perfect business model.
And honestly, why wouldn't you think that? I mean, every single day, millions of Americans deposit their paychecks, swipe credit cards, and hand over their life savings to you. To a new owner, it kind of looks like an endless stream of free money pouring right into your lap.
But, and here is the massive reality check, it really isn't free money. That cash doesn't just sit there chilling in a giant vault waiting for you to spend it. Owning a bank isn't about storing cash at all. It's about deploying it. And as you'll see, the fate of those deposits is literally the foundation of the modern economy.
Part 1. The Engine. Uncovering the secrets of banking revenue.
Okay, let's look at a super simple example to see how this engine actually survives. Say a customer walks in and deposits $100,000, fully believing their money is perfectly safe. To them, it's just sitting there. But behind the scenes, you are immediately putting that capital to work.
Instead of hoarding it, your bank takes a massive chunk of that cash and deploys it, acting as this critical bridge between people who save and people who borrow. You're funding first homes, providing capital for small businesses, issuing student loans for tuition, and financing new corporate factories. You are the engine keeping the economy moving.
So your whole survival, it relies on literally one of the oldest business models ever created, the interest spread. Basically, you borrow from your depositors at a tiny fraction of a percent, and you lend that exact same money out at a much higher premium.
It's this huge balancing act. The difference on one single customer's account might seem totally negligible, right? Just pennies. But scaled across millions of people, it generates billions of dollars in annual revenue. America's largest banks handle trillions not because they own the money, but because they expertly manage this exact spread. Section 2. The gamble. The reality of lending risk. Now here's where things get real, because this whole system is actually an incredible gamble. Your real revenue comes from managing long-term, illiquid loans. You're collecting interest on 30-year mortgages, decade-long business loans, and rolling credit card balances. These are serious commitments, stretching decades into the future. But you have to ask yourself, what happens to your business if the economy suddenly turns? Like, what if homeowners just stop paying, or businesses go bankrupt, or unemployment suddenly spikes? Well, the harsh reality is that every single missed payment is a direct hit to your balance sheet. If enough borrowers fail, even a highly profitable bank can find itself in serious trouble, because at the end of the day, the future is impossible to predict. And this is exactly why risk assessment is absolutely crucial. It's your primary defense mechanism. You can't just hand out money to anyone. You must meticulously examine income, credit scores, current debt, and financial history to protect your business. Yet, even with all that algorithmic precision, some default rate is just permanently baked into the model.
Part 3. The climax. When liquidity and trust disappear.
Okay, picture this terrifying scenario. It's Monday morning, and a rumor spreads online claiming your bank is completely out of money. Your loans are still good, your assets exist, but panic takes over. Thousands rush to withdraw their savings all at once. Suddenly, you face a massive liquidity crisis. Your cash isn't sitting in the vault. It's tied up in those 30-year mortgages and long-term business loans we just talked about. You have the assets for sure, but you lack the immediate cash. This is your classic bank run. And if history has taught us anything, it's that fear moves way faster than facts. A perfectly healthy balance sheet literally means nothing if enough people lose confidence at the exact same time. Massive banks have collapsed not because they actually ran out of money, but simply because the public believed they had. Which brings us to this profound truth. The most valuable asset you will ever own as a bank doesn't live in a ledger. It's not gold, it's not skyscrapers, and it's definitely not servers. It is absolute trust. Because the moment that trust vanishes, even for just a few hours, billions of dollars evaporate right along with it. Your entire business model relies on faith. So since losing trust can destroy your business overnight, it leaves us with a really critical question. Why does owning a bank mean answering to some of the strictest regulations in the world? And more importantly, what is the invisible safety net operating behind the scenes to keep the entire system from collapsing during a panic? Because the reality is, our financial system relies on far more than just storing cash. It relies entirely on our collective belief in it. So what really happens when that belief is tested?